Nancy had been a Vanguard investor for 23 years. She trusted them the way most careful investors trust Vanguard, completely and with good reason. Low fees, index philosophy, no nonsense. She had built $740,000 in a target date fund and never lost sleep over it. Then her daughter sent her an article about something called the BETR rule. Nancy read it twice. Then she called her brother, who had a finance background, and read it to him over the phone. He was quiet for a moment. "Mom," her daughter said later, "are you okay?" She was fine. But for the first time in 23 years of trusting Vanguard, she had a question she did not know how to answer. Was the fund she had chosen, the one Vanguard recommended for someone retiring in her window, actually right for her? In this video, I am going to explain exactly what the BETR rule is, what Vanguard was trying to do with it, and, most importantly, why a rule designed to help retirees may be working against a specific category of investor that Vanguard never intended to harm. If you hold a Vanguard target date fund, or if you are planning to, this video is about your money. Stay with me. Before the BETR rule, let me explain why Vanguard's decisions matter more than most fund company decisions. Vanguard manages approximately $8.5 trillion in assets. Its target date funds, the funds that automatically shift from stocks to bonds as you approach retirement, are the default investment option in millions of 401k plans across the United States. When a new employee at most major corporations enrolls in their retirement plan and chooses nothing, they are usually put in a Vanguard target date fund. This means that Vanguard's decisions about how to build these funds are, effectively, retirement decisions for tens of millions of Americans who never made an active choice at all. The influence is extraordinary, and with it comes a specific responsibility that most fund companies simply do not carry. So when Vanguard changes something fundamental about how its target date funds are constructed, as it did with the BETR rule, the question is not just, is this change good? It is this change good for everyone it affects? And the answer, as Nancy discovered, is more complicated than Vanguard's communications suggested. So, what is BETR? BETR stands for Beliefs, Expenses, Time Horizon, and Risk Tolerance. It is Vanguard's framework for personalizing retirement income recommendations, an attempt to move away from one-size-fits-all glide paths and toward something more responsive to individual circumstances. The specific change that triggered the most attention was Vanguard's adjustment to the equity allocation in its target date funds for investors near and in retirement. Vanguard increased the stock allocation, the percentage held in equities rather than bonds, for investors in the years immediately surrounding their retirement date. The reasoning was straightforward and defensible. With people living longer, holding too many bonds too early creates longevity risk, the risk of outliving your money. A higher equity allocation in early retirement captures more growth and extends portfolio longevity. On average, for the average investor with average expenses, average longevity, and average risk tolerance, this change is probably correct. The academic literature supports higher equity allocations in retirement than the conventional wisdom of previous decades suggested. The problem is the word average. Here is who the BETR adjustment potentially works against, and Nancy is in this group. The higher equity allocation increases expected returns over the long term. It also increases volatility in the short term. For an investor with a long-time horizon and stable income needs, that trade-off makes sense. For a specific category of retiree, it introduces a risk that the long-term return improvement cannot compensate for. That category is the retiree with high fixed expenses relative to their portfolio, retiring in a period of above-average market valuations in the early years of their withdrawal phase. We covered sequence of returns risk in the $2 million portfolio video. The specific danger that a significant market decline in the first 3 to 5 years of retirement can permanently impair a portfolio's ability to recover, even if long-term returns are normal. A higher equity allocation in the target date fund increases exposure to exactly this risk. Nancy is 64. She plans to retire at 66. Her fixed monthly expenses, mortgage paid off, but healthcare, property taxes, food, utilities, total $3,800 per month. Her Social Security will cover $2,100. Her portfolio needs to generate $1,100 per month from day one. At current market valuations, her Vanguard target date fund's increased equity allocation means that a 30% market correction in year one of her retirement, the kind that happened in 2022, would reduce her portfolio from $740,000 to approximately $518,000. From that reduced base, her withdrawal rate climbs from a sustainable 3.1% to a stressful 4.8%. The sequence of returns risk is real, and it is specific to her situation. Vanguard's BETR framework is supposed to account for individual circumstances. In practice, for investors in the default target date fund who never interacted with a Vanguard advisor, the BETR adjustment happened without any individual analysis at all. Subscribe before we go further, because the second half covers what Nancy actually did and what the right framework looks like for evaluating your own target date fund. Before we continue, I am not a financial advisor, and nothing on this channel constitutes personalized investment advice. I am sharing research and analysis, not professional recommendations. Vanguard is a respected institution, and the BETR framework represents genuine intellectual effort on their part. The concerns I raise are specific to certain investor situations, not a general indictment of Vanguard or target date funds. Please consult a qualified financial advisor before making any changes to your retirement investments. Now, let's continue. Here are the 3 questions Nancy's brother walked her through, the ones that determine whether the BETR adjustment works for you or against you. Question 1. What is your withdrawal rate in the first 5 years of retirement? Take your annual expenses minus your guaranteed income, Social Security, pension, annuity. Divide the remainder by your portfolio value. If the number is below 3.5%, a higher equity allocation is likely fine. Your portfolio has enough buffer that short-term volatility is manageable. If it is above 4.5%, the sequence of returns risk from higher equity exposure is a genuine concern that deserves specific attention. Nancy's number, $2,400 per year from the portfolio, divided by $740,000. That is 2.75%, actually in the safe range. The initial fear was larger than the actual risk. This is the most common outcome of running the numbers honestly. The situation is better than the anxiety suggested. Question 2. What is your time horizon and health picture? The BETR framework is explicitly designed for people with longer retirement horizons, 25 to 35 years. If you have significant health issues, a family history of shorter longevity, or a retirement horizon of 15 to 20 years, the longevity risk that higher equity allocation addresses is genuinely lower for you. The bond-heavy allocation that Vanguard moved away from may actually be more appropriate for your situation than the updated glide path. This is not pessimism, it is arithmetic. A portfolio that needs to last 18 years has different optimal equity exposure than one that needs to last 32. The BETR framework assumes the longer horizon by default. Question 3. Do you have a cash buffer? We covered the 2-year cash buffer in the $2 million portfolio video. If you have 18 to 24 months of living expenses outside your investment portfolio in a high-yield savings account or treasury bills, the short-term volatility of a higher equity allocation becomes dramatically less dangerous. The buffer means you never have to sell equities into a decline. You live on cash while the portfolio recovers. The cash buffer changes the risk calculus of the BETR adjustment entirely. With it, higher equity exposure is manageable. Without it, higher equity exposure in early retirement is a specific risk that the expected return improvement may not compensate for if timing is unfavorable. Nancy ran the 3 questions. Her withdrawal rate was 2.75%, safe. Her health was good. Her family history suggested a long retirement. The higher equity allocation made sense for her horizon. And she had $140,000 in a money market account outside her investment portfolio, more than 2 years of buffer. Her conclusion: the BETR adjustment was not working against her. She had been in the right fund all along. The article had frightened her without having enough information about her specific situation to justify the fear. This is the most important thing I want you to take from Nancy's story. The BETR rule is not a scandal. It is not evidence that Vanguard is working against its investors. It is a framework change that is right for most people and potentially mismatched for a specific minority. And the only way to know which category you are in is to run your own numbers, not read an article about someone else's. Nancy called her daughter back that evening. "I looked at it," she said. "I'm fine. The fund is right." Her daughter asked how she knew. "I ran 3 numbers," Nancy said. "It took 40 minutes. Here is the broader point that Nancy's story illustrates. Vanguard is one of the most investor-aligned institutions in American financial history. The index fund revolution they pioneered has saved ordinary investors hundreds of billions of dollars in fees that would otherwise have gone to active managers. The trust Nancy placed in them for 23 years was not misplaced. But trust is not a substitute for understanding. A fund designed for the average investor is designed for nobody in particular. The BETR framework is a genuine attempt to move beyond average, but it is still a framework applied at scale to millions of people simultaneously, without individual review. Your retirement is not average. Your expenses are not average. Your health, your longevity, your cash position, your guaranteed income, none of it is average. The fund can only approximate. The approximation is your starting point, not your final answer. The 40 minutes Nancy spent running 3 numbers gave her something Vanguard could not: the specific answer for her specific life. That 40 minutes was the most valuable financial work she did in the year before her retirement. Here is what I want you to do this week. If you hold a Vanguard target date fund, look up your fund's current equity allocation. It is on the fund's page on Vanguard's website. Then run the 3 questions. What is your withdrawal rate in year 1? What is your realistic time horizon? Do you have a cash buffer of 18 to 24 months outside the portfolio? If your withdrawal rate is below 3.5% and you have a buffer, the better adjustment is almost certainly fine for you. Stop reading articles designed to alarm you and go back to the strategy that built your balance in the first place. If your withdrawal rate is above 4.5% and you do not have a cash buffer, talk to a fee-only financial advisor before your retirement date. Not to move out of Vanguard, but to build the buffer and review whether a slightly more conservative allocation makes sense for your specific first 5 years. Tell me in the comments, do you hold a Vanguard target date fund? And did you know what equity allocation it holds right now? Most people I speak to do not. I read every single comment. Subscribe. Because next week, we are covering why 90% of Americans will never retire. And it is not the story about discipline or income that most people tell. It is 4 specific, predictable decisions that compound quietly for decades. After today's video, you will recognize all 4 immediately.